right, what's happening, everybody? Welcome back. Our next topic, the math. I like the math. Show me my ratios, Horatio. So what are ratios used for? In the real world, this is what an equity analyst or a fixed income or credit analyst, these ratios are going to help them determine what the inputs to their valuation models or credit models should be. So ratios are going to be used to determine a bunch of things. Number one, risk, operating risk, financial risk, which are both important when determining required rate of return. Number two, performance. How successful is this company? What kind of returns do they have on their invested capital, on their assets, on their equity? We also want to see, does this company have growth potential? So that's very important if you're looking to be a stockholder, especially a common stockholder. And then ultimately value, all right? So ratios are going to help us determine all of these things. Now, the ratios can also help us quickly identify red flags. Something doesn't look right. So when you calculate a current year ratio, by itself, it doesn't have as much value as when you compare it to a benchmark, a standard, which could be the industry standard. Okay, what are the peers doing? Or it could be this own company's historical average, okay, what it normally is. But the ratios focus our attention on relevant information from the financials. So again, we could use that information to compare with prior periods. That's known as trend analysis, or compare to competitors, which is called cross-sectional. All righty, now we're going to be looking at the target company relative to itself. Sometimes you'll have to calculate the ratio. Sometimes they want you to analyze and interpret the ratio and determining the trend. So is the company improving or deteriorating? Okay. You could also, as a primary user, an investor, a potential investor, a creditor, whatever, you can also second guess management, the pros and cons of management decisions. Like, for example, was it such a good idea to have this level of operating risk, this level of fixed costs when they could have chosen variable costs as well? Capital structure is often a decision that's second guessed by the primary users, the amount of debt versus equity, how they raise their capital. All right, when you do the math, folks, whatever the ratio is, it has a direct relationship with the movement in the numerator. Numerator's up, ratio's up. Conversely, whatever you calculate for that ratio, it has an inverse relationship with the denominator. As the denominator goes up, that ratio goes down. Okay, when you look at financial statements, folks, be careful. Which column is the current year? All right, so it doesn't always have to be the first column. Here, the first column is the current year. The column on the right is the prior year. The balance sheet. Now, what's the purpose of the balance sheet? To determine financial risk as well as your capacity to produce. What do I mean by financial risk? Short-term risk, liquidity. Are your current assets sufficient to pay your liabilities as they become due? Long-term risk, solvency, capital structure, how you raised your debt versus your equity, and then looking at your asset composition, not only current versus non-current, but change in assets. Are they growing or are they downsizing? Alrighty. Balance sheet can rarely be used to directly value the entity. Why? Because most assets are not on the books at fair market value. Even your long-term debt, your bonds in the U.S., it's at historical cost. What the cost of borrowing was when the debt was issued, rather than today's cost of borrowing, okay? So we can't use the balance sheet to directly value, but it certainly helps us determining financial risk and our capacity to produce and grow depending upon the size of our inventory, the size of our PP&E, etc. Okay, the income statement, same thing. Make sure you're looking at which column, current year, okay, that's our first column. Year one, that's to the right, that's our prior year. Why are we looking at the income statement again? Obviously, performance. Efficiency is where we start. Was management able to turn those assets over and create sales, right? An asset of probable future economic benefit. Does that plane actually fly passengers? How many packages is that UPS truck delivering? How much sales is that particular store generating? So turning over the assets into revenue. And it's nice to have high sales, but you walk around any mall around the U.S., you see a lot of these stores going out of business. Even if they have high sales, sometimes the rent is so high, their margins are really low. So step number two, after the asset creates revenue, can the revenue create profit for the owners? Okay, the profit margins, turning the sales revenue into profit. Now, when we look at the income statement, we're also going to be looking at operating risk, volatility in sales, volatility in earnings, okay? So that's operating risk. Now, the other financial statement we want to look at is the statement of cash flow. The statement of cash flow is extremely important. It helps us pretty much do everything. Value the company, especially if you're using free cash flow valuation models. It helps us determine risk. Can you generate cash from your core business, your quality of earnings, what's your operating cash flow growth rate at relative to what's on the accrual basis income statement. Cash flow helps us determine performance. If your operating cash flow is growing and your cash conversion cycle is getting shorter, well, you know what? You're performing at a really high level. So statement of cash flow, very important, specifically operating cash flow. Other information you want to look at, well, if you're a stockholder, dividends per share. It's part of the return on your investment. There's two ways to make money on common stock, the dividend and or the change in the stock price, right? So return on investment, dividend per share. And then ultimately, if you're an equity analyst, you look at the company's market price per share, and then you're going to try to figure out the rational, the fundamental, the intrinsic value. What should it be given the fundamental factors that drive value, like earnings, dividends, required rate of return, growth, etc. So do you think that market price is overvalued or undervalued? Okay. Now, some limitations on ratios, folks, heavily dependent upon the reliability of the data. So we're pulling the numbers from the financials. So if the financials didn't get a clean opinion, I'd be very hesitant on using those financials, okay? We also got to be mindful of not only adverse opinions, but qualified opinions and except for, is that something significant that's going to affect our valuation or risk assessment? We also want to be mindful of, even if they get a clean opinion, what methods of accounting did they use? What estimates? So LIFO, FIFO, straight line, accelerated depreciation. Are they capitalizing, expensing? When management has choices, are they being relatively conservative, lower asset, lower profit, or are they being relatively aggressive, a higher asset, a higher profit? Now, there's other information that's going to be very valuable when analyzing a company. The benchmark, the standard outside the company. What are the industry averages? What are the peers doing? Okay, so when you have a ratio, you need to compare it to something. Now, when you do horizontal analysis, you're going to take a look at the target company relative to itself over time, relative to a base year. So your assets might be 1.25 of what they were just 3 years ago, if that's the base year. Maybe your debt is only 0.8 of what it was 3 years ago. So horizontal analysis, when you look at the target company relative to a base year, helps you to quickly identify trends and material changes, like change in capital structure. The debt went down, the equity went up, or vice versa. Change in asset composition, more non-current assets versus current assets. You're more aggressively managing the assets. When you have more non-current assets, you're less liquid, but you're likely to get a higher return on non-current assets than cash or marketable securities. Then there's vertical analysis, taking every number on the income statement, dividing it by sales, taking every number on the balance sheet, dividing it by total assets. So you want to take a look at, the composition of, let's say, of your income statement. Are your expenses, your cost of goods sold, going up or down relative to what they were historically? Maybe you want to take a look at your profit margins, your operating margin, or your net profit margin, whatever. But you take every number on the financial statement, you divide it by either on the balance sheet, total assets, also known as total capital, or on the income statement, total sales, okay? Then you could look at those margins, you could look at the compositions and see what the change is over time, and you could also do a comparison of the company's ratio to maybe other entities, the industry average. Look, it's very difficult to compare Home Depot or Lowe's to a mom and pop hardware store. It's almost impossible because the large entity, their numbers are going to be bigger in every way versus the small mom and pop. But it's interesting when you create what's called a common size financial, which is what a vertical analysis is, and you take every number on the financials and convert it to a percentage. Like, for example, when you look at cost of goods sold for a Home Depot or a Lowe's, dollar-wise, it's going to be so much bigger than the mom and pop. But you know what's interesting? When you take a look at the cost of goods sold as a percentage of sales for the large entity, I bet you that's a lot lower. I bet you the gross margin is going to be much higher for the larger entity. The cost of goods sold as a percentage of sales much lower for the larger entity. Why? Economies of scale. The mom and pop doesn't buy in that volume. They're probably not going to get the same purchase discounts that are offered to the bigger entity. Okay, now with any profitability ratio, Not only do we want it to be greater than or equal to historical performance or the benchmark, the standard, whatever the performance metric is, we want to make sure it's sustainable. Remember, bottom line net income does not necessarily represent your operating income. Remember, the top part of an income statement is your core business, your operating. Then you have your unusual or infrequent, your gains and losses. And then you have the highly irregular bottom of the income statement, the discontinued operation. All right, so we want to make sure we understand what we're looking at and what it tells us and what it doesn't. But general rule of thumb, hey, profitability ratio is greater than or equal to the standard, we're happy. Success or failure, okay, for a period of time. Income statement, that might be for the quarter or for the year. Now, your gross margin is heavily dependent upon what's happening to your cost of goods sold. Hopefully that's going down. That gross profit margin is heavily dependent upon the bargaining power of your suppliers. We hope there's a number of suppliers out there where we could play one off the other and capture a lower price. That'll give us lower cost of goods sold, higher margins. So we hope that the suppliers do not have the bargaining power we do. Profit margin is heavily dependent upon competition. Folks, as your competition goes up, substitutes go up, profit margins are going to go down. So when we look at our bottom line profit margin, we're looking at what's the trend, but also is it sustainable? What is driving that profit margin? Obviously, if our profit margin is growing, I hope it's due to our core business, something that we can repeat. And conversely, if our profit margin went down, I hope that's due to something unusual or infrequent, or maybe a discontinued operation or some kind of unusual write-off. Okay. Now, folks, your return on sales is really your operating margin. Step number one is getting your numerator. You need your EBIT. You take your net income, you add back your taxes, and you add back your net interest. Assuming your interest expense is greater than your interest income, you're adding back your net interest expense. If your interest income were bigger than your interest expense, you do the opposite. Assuming interest expense is greater than interest income, net income plus taxes, add back your net interest expense, folks, that's EBIT. That's in your numerator. EBIT divided by sales is known as your operating margin. And that's heavily dependent upon, obviously, what's happening with your operating expenses. So your cost of goods sold, your number of suppliers, right? SG&A, heavily dependent upon competition, intensity of rivalry. Are we having, a price war or advertising war where we're doing a lot more in specials and advertising and all that kind of stuff? And then when you're in a capital intensive industry, that operating margin is also heavily dependent upon depreciation, which is also dependent upon age of the asset. If it's older, you won't have as much to depreciate, as well as your method of depreciation and your estimates for salvage value, useful life. But that's your operating margin. That generally represents your core business. And if you did a top-down approach, that's your sales minus your cost of goods sold, minus your SG&A, minus your depreciation. But a lot of times it's bottom up. Net income, add back your taxes, add back your net interest expense. Okay, and there's your EBIT. Obviously, where do you want your operating margin to be? Also known as return on sales, greater than or equal to the standard. Hopefully it's growing and it's sustainable. Okay, return on asset now. Remember, management has to decide capital structure, how they're going to raise their capital, debt, or equity. Then what businesses are we going to invest in? What industry? So we want to make sure that we buy assets that could be turned over into sales. So when you measure performance, general rule of thumb is we want a higher sustainable turnover. Have those assets create a lot of revenue for us. And number two, when we do have sales, we're hoping a lot of that revenue falls to the bottom line, profit for the owners. So return on assets is really a combination of the turnover and the profit margin. Notice the ratio. Your numerator is net income per the income statement. Your denominator, though, is from the balance sheet. So, folks, whenever a ratio mixes income statement with balance sheet, if possible, the balance sheet number should be an average because the net income only represents the current year, but the balance sheet is cumulative, okay? So, if possible, we want average total assets. Self-evident, greater than or equal to the standard. We want our return on assets to be growing and greater than or equal to the benchmark, the industry peers, whatever. But we also want it to be sustainable, right? So we've got to look, if you've got really old assets, if you're an airline and you're flying airplanes from the 60s, number one, I don't want to get on that plane. But number two, that's probably fully depreciated. The asset in the denominator is probably next to nothing. Of course, you're going to get a high return on asset. But those planes are so darn old, by the time Next year rolls around, you got to buy a new fleet of airplanes. The return on assets going to plummet next year. So we want to make sure it's high, growing, but sustainable as well. Okay, so in the DuPont model, return on assets looks at it rather than net income divided by average total assets. We want it explained. We want to know what's driving the return on asset. So we break it into its two core components. How do you calculate profit margin? Net income divided by sales, both from the income statement, no averaging, times sales divided by your average assets, your turnover. Turnover is heavily dependent upon management efficiency, the optimal number of assets. If you're UPS, you don't want too many trucks, but you don't want too few. If you're Starbucks, you don't want to have too few stores, but you don't want to have too many either. Okay, so what's the optimal amount of stores, of trucks, of airplanes, the optimal amount of assets? And then again, profit margin is heavily dependent upon competition, the substitutes, etc. All right, we want to determine sustainability. So look, whether you calculate return on assets using a single fraction, net income divided by assets, or the details, profit margin times turnover, same result, 7.22. The other thing that's great about the DuPont return on assets, it tells you a lot about the type of industry you're in. Okay, do you have really high turnover or really high margins? It'd be nice to have both. But truth be told, it's usually one or the other. Like if you own a dollar store, chances are you're going to have really high turnover, but your profit margins per unit sold are going to be really low. Conversely, if you sell luxury goods, let's say you sell yachts. You see Jeff Bezos, that yacht that man's got, unbelievable. But nonetheless, I don't know where I'm going with that. Oh, I'm thinking of Garrity's yacht. Yeah, so when you have yachts, your turnover, if you manufacture yachts, is going to be much lower. Unfortunately, not of all of us can shop with Jeff Bezos. So a turnover will be much lower. But when they sell a yacht, the profit margin is not going to be a couple of bucks, right? It's probably a couple of $1 million per boat sold, if not more. Okay. Now, if you're a stockholder, you're very concerned about return on equity. Because when you determine whether or not you should buy a company's stock, step number one should be, well, what's my required rate of return given the level of risk I'm assuming, the operating risk, the financial risk, etc. You come up with a required rate of return, you'll be happy so long as the return on the equity is greater than that required rate. So when you look at return on equity, you need to understand that's different than return on asset. The return on asset is amplified by the company's degree of financial leverage, how they raise their capital, what combination of debt versus equity. So when you take the company's return on asset and you multiply it by the degree of financial leverage, now you've got your return on equity. That is directly related to not only the return on asset, but the risk, the financial risk management is willing and able to assume, the financial risk, the capital structure, all righty, that degree of financial leverage. Just crunching the numbers in a single ratio, net income divided by average total equity, because we're mixing income statement and balance sheet, self-evident, we want that return on equity to be greater than or equal to our required rate. Okay. Last ratio in this set, folks, we want to make sure we're generating enough cash internally from our core business to cover the liabilities that are coming due. So this is really an operating cash flow coverage ratio. Is the numerator sufficient to cover what's due in the denominator? Okay, and the operating cash flow is cash generated from the core business. It's not affected by methods or estimates. It's the cash collected minus the cash paid from your core business. The higher the operating cash flow coverage ratio, the less risk of short-term distress. So we want that ratio greater than or equal to the standard. Now, is 0.396 good? Well, is not enough in the numerator to cover. The numerator is only 40% of the denominator. But I don't know, in the abstract, that might be good for this industry. It all depends. What's the historical number? And then what's the industry average? And then you could determine whether or not 0.396 is good or poor. You got to have a benchmark by which to compare it. Okay, more ratios to come. I know you love this stuff. You might, there's a lot here. You might want to try some questions just on that, or if you want to do it in bulk, you can wait a couple more videos and then bang them out. Up to you, depending upon your comfort level. See you back in a little bit.